is this big enough? Is this bazooka big enough? If SVB and Signature and was Bear Stearns, there's a Lehman ahead of us in a few months. That to me is what the summer of 2023 could look like. And so what concerns me is that although Bitcoin is responding appropriately to what is obviously a tacit pivot by the Fed, if you buy it at today's price, you might have to ride it down a significant wave.
Hey guys, welcome back to Let's Talk Crypto. Bitcoin has had a great response to the banking crisis so far, but the question remains, were SVB and Signature Bank collapses the first of many more to come? Darius Dale, the founder and CEO of investment research firm 42 Macro, is concerned that the downfall of these banks wasn't big enough and we might be looking at a Lehman Brothers type event. Dale acknowledges that the rise of Bitcoin amidst the banking crisis is exactly what it was created for. However, despite having a very bullish outlook for 2024, he believes that we have not yet reached the bottom of the risk investment cycle, as the macroeconomy is leaning towards a recession in the third and fourth quarters of this year. That said, Dale sounds the alarm bell, and warns investors that this is not the right time to buy any risk assets, as they might have to endure a long downward wave before markets bottom out. Let's listen to Darius Dale as he shares his macro outlook for this year, and what it will take for Bitcoin to reach new all-time highs in 2024. But before we do, please consider subscribing to our channel, as we bring you daily content on the latest crypto news. And now, let's jump right into the video.
Let me start just by addressing the move in Bitcoin, given that we're seeing, it's appropriately responding to these headlines about liquidity. I think this is exactly what Satoshi Nakamoto wanted, which is, hey, this banking thing that we call the global financial system does not work. It's bound for failure. It's eventually going to fail. Here's an alternative. Now, that makes a lot of sense in terms of the pump that we're seeing in Bitcoin. And I do believe structurally, longer term, it's the appropriate response for asset markets and market participants to make. What concerns me about the path is that we have not seen the wave of deflationary private sector money creation that could very much be ahead of us. And in fact, is according to the Eurodollar curve, is likely to happen in the next few months. And so what concerns me is that although Bitcoin is responding appropriately to what is obviously a tacit pivot by the Fed, at the very minimum, it could be a big pivot by the Fed in the matter of a couple of months. But I'm concerned that if you buy it at today's price, you might have to ride it down a significant wave in order for it to find an ultimate bottom before, in order for asset markets to really find an ultimate bottom, because there's nothing more damaging to your longer term net worth than deflationary money out of the private sector. It's what happened when Lehman went bust. It's what happened in 1998 when long-term capital management went bust. It's what happened in the dot-com bubble. It could potentially be happening here. So I just want to make sure that, hey, look, although Bitcoin, Ethereum, all these things are going to be longer-term beneficiaries of the banking sector being nationalized and effectively socialized, I just don't think that now is the appropriate time, given where we might be in the process. There's two communities of investors with respect to digital assets, right? And there's one community that just says you buy at all price, at any price, and hold it forever. But for those who don't like losing money, there's a concept in finance that I think is very under discussed with respect to financial Twitter, crypto Twitter, et cetera. It's called volatility drag. And what it effectively means is that if you lose money in the very early innings of your investment cycle, you can wind up with the same average return as another investor, but the person with the same return who did not lose money at the beginning of that process winds up with way more money. And so to answer your question, fine, if you want to buy Bitcoin at any price and every price, that's not what I'm here to discuss. What I'm here to discuss are those investors who are thoughtfully and tactically increasing their exposure and decreasing their exposure to digital assets, of which we are certainly in that community, dating back to November 2021, when we told everybody to sell their digital assets. We are amongst that community of investors that thinks, I wouldn't say timing is the appropriate word, but certainly trying to use the macro cycles to time, where we are in that broader investment cycle. And I don't think we're anywhere near the bottom of the risk asset investment cycle. There's a few steps in this process. I think we're celebrating step one, which is, hey, we finally got the Fed's attention. That's step one. Step two is this big enough? Is this bazooka big enough? And if step two is no, if the answer to step two is no, we're going to have to probe new lows in assets and try to figure out who's next on the list that we can offer up as a sacrifice to the Fed to get them to do even more pivoting. And if that's not big enough, then we have to offer up an even bigger institution at the Fed a few weeks or a few months from now to get them to do even more pivoting. I mean, I liken it to Bear Stearns ultimately leading its way to Lehman. You know, if SVB and Signature was Bear Stearns, there's a Lehman ahead of us in a few months. And I'm not. I think it would be very imprudent as a CEO of a company to tell any investor that it's appropriate to buy risk assets today, knowing that there could potentially be a Lehman ahead of us. Again, when you think about liquidity, it's not just what the central bank is doing. Obviously, if the central bank is expanding its balance sheet in a material way, in an unencumbered way, i.e. QE, as opposed to bank discount window funding, that's positive. But what is you have to get our hands on, and I'm not sure that anybody has statistics or idea because it's such a quickly moving beast. We have to get our hands around what's happening with private sector money creation. Is private sector money going to be deeply negative? Because that's the other side of the liquidity cycle narrative, right? China cutting PBOC, Fed discount window uptake, that's all good. It's better than nothing. I completely agree. Stock should be up, Bitcoin should be up, but is it enough to fix the problem? And I don't think we're far enough along in this process. And I do emphasize the word process to understand whether or not this is enough to fix the problem.
Considering the shift in the Federal Reserve speech at the last FOMC press conference, hinting that they may pause rate hikes in May, is this enough to take Bitcoin on the next bull run? Let's hear Dale's opinion on this.
He says 25, he talks up, hey, look, we have all the tools it takes to deal with this and da-da-da-da-da. And I don't think markets are going to like it. And the reason the markets aren't going to like it is because what they actually what would send Bitcoin back to 69,000 and beyond, in my opinion, would be, look, we're done with hiking. We see a wave of deflationary money upon us. By the time we're done having this conversation in 3 or 4 weeks, I'm air quoting Powell here. By the time we're having this conversation in a few months, then it'll be very clear that deflation's on the tape. We've achieved our inflation mandate. Unemployment is rising. It's time to actually supply the market with rate cuts and QE. That is probably what markets need. The problem is with unemployment at a 50-year low, inflation compounding at 2x the Fed's rate, price stability mandate, and nominal GDP still growing above trend, they can't say that. But we as investors can anticipate that, and more importantly, do things in financial markets that force their hand on that. And the things that we do in financial markets to force their hand on that are deeper inversions in the Eurodollar curve, significant declines in risk asset prices, stocks, crypto among them, and obviously, uninversion of treasury curves, looking at 2s, 10s, for example, to signal things like a recession is a very near-term probability. That, to me, is what the summer of 2023 could look like. And so, that's what I'm trying to sound that alarm bell, which is, yes, we're starting to get a little bit of that liquidity response, but it might not be big enough. The big liquidity response could be ahead of us after we have to go through the soup first. One of the reasons that it took the world a long time post GFC to feel better, I would argue probably took to 2013 for the economy to feel like it was back, really. Certainly it felt that way in my review of the media at the time, is because we had a legitimate issue with private sector credit. There was too much private sector credit. Nobody wanted to hold those assets. We knew they weren't money good. And ultimately, there was a long default cycle, and the tail of the default cycle, i.e. tighter lending standards, persisted with us for many years after the GFC. That's not the case here. And on one hand, that's positive as it relates to 2024. And quite frankly, I fully expect to be a raging bull in 2024. We'll probably be shorting every treasury bond in sight in that moment as well, including the US dollar as well. But I think there are some steps to get there there's some steps to take before we get there. One, the markets have to figure out, the markets are basically the conduit that speak from investors to the Federal Reserve. And the markets need to tell the Fed, not only do you need to back off, but you need to actually supply the market supply the financial sector with enough capital so that we can get rid of this hole. We need to socialize those losses for us to all be able to comfortably move forward. And once we're able to do that, I think things will be just fine. But the problem with going from fully employed economy, inflation compounding at more than 2x the Fed's price stability mandate, to the Fed supplying open-ended QE, not discount window financing, which needs to be paid back, but open-ended QE and rate cuts, there is a process of us market participants having to speak to the Fed to get what we actually want. And to me, that's the scary part about this, which is it could be very sharp, it could be very sudden. And once it's sharp and once it's sudden, that obviously causes a sharp, sudden, potentially very deep, nasty recession. But it could also be a very sharp, sudden recovery as well, heading into 2024, or maybe in the first half of 2024. So, we're not structural bears. I think we're probably going to see some really low lows we revised down our S&P 500 price target to 28.45 this morning. 28.45. Could we be there by sometime in Q3 or Q4 of this year? If this gets ugly, absolutely. But I think you buy there because, again, ultimately we're going to get what we want from the Fed. It just may take a couple of innings and a couple of iterations of this back and forth process of trying to figure out where the counterparty risk is, who has what on what balance sheet, and so on and so forth.
What are your thoughts on Dale's prediction for the summer of 2023? Will Bitcoin and other cryptocurrencies be dragged down along with the stock market? Let us know in the comments below. If you enjoyed this video, please make sure to give us a like and subscribe. Thank you so much for watching. This is Let's Talk Crypto, and we'll see you in the next video.